Semiconductor stocks just erased hundreds of billions in value, while old economy stocks nobody talks about hit all-time highs. The Dow Jones climbed to a record on the exact day that chip giants tumbled, and the reason has nothing to do with what investors think about the future. It's pure math. The Dow is a price-weighted index of just 30 companies, and not one of them is a pure chip maker. When Nvidia or ASML crashes, the Nasdaq collapses because tech dominates that index. But the Dow barely notices. It's stacked with industrial names, Boeing, Caterpillar, UnitedHealth, companies that can rally on completely different catalysts. What makes this moment strange is the scale of the divergence. Chip stocks have driven market gains for 2 years straight, but their weight in the Dow is effectively zero. So when semiconductor fears spiked, whether over China export controls, AI spending doubts, or cyclical weakness, trillions in market cap evaporated from the Nasdaq while the Dow kept climbing on bank earnings and industrial orders. The gap reveals something uncomfortable. The index most investors watch tells a completely different story than the one driving the actual economy. India's Reserve Bank Monetary Policy Committee announced it is keeping the benchmark repo rate unchanged at 5.25%. The decision maintains the current cost of borrowing for commercial banks from the central bank, affecting interest rates across the economy. The Hindu reported the announcement during a live coverage of the RBI's monetary policy statement. This rate decision directly impacts loan costs for businesses and consumers, influencing spending and investment across India's economy. The hold signals the RBI's assessment that current monetary conditions balance growth support with inflation management, reflecting the central bank's cautious stance amid global economic uncertainty.